A bank will approve you for a mortgage significantly larger than what's actually safe and comfortable to take on. This isn't a conspiracy, it's just that bank approval and real affordability are answering two completely different questions. And most people only ever hear the bank's answer. By the end of this video, you'll know exactly why those two numbers diverge, the hidden costs that don't show up in a pre-approval letter, and the precise step-by-step calculation for figuring out what you can actually afford using your real take-home pay instead of your gross salary. Part 1. How banks actually calculate your approval. Mortgage lenders typically calculate your maximum approval using debt-to-income ratios based on your gross income, your salary before taxes, healthcare premiums, retirement contributions, or anything else is deducted. This single choice already inflates the picture, since gross income is always a meaningfully larger number than what you actually receive. Lenders commonly use two thresholds: a front-end ratio, capping housing costs at roughly 28 to 31% of gross income, and a back-end ratio, capping total debt payments, including the new mortgage plus existing debt, at roughly 36 to 43% of gross income, sometimes higher depending on the loan program. It's worth being clear about the incentive here. The bank's approval process is designed to protect the bank's loan by checking whether you're statistically likely to keep paying it. It isn't designed around whether the payment leaves you with a comfortable, flexible financial life. Those are related questions, but they're not the same question, and the gap between them is exactly where people end up house poor. Approved for the loan, technically able to make the payment, but with very little room left for anything else. Part 2. The real ratio to use instead. Here's the adjustment that closes most of that gap. Calculate your target housing costs as a percentage of your net take-home pay, what actually lands in your account after taxes and deductions, rather than gross income. And use a meaningfully more conservative percentage than the bank's maximum. A reasonable target for most people. Total housing costs, meaning the full pity payment, which we'll define in Part 4. At or below roughly 25 to 28% of take-home pay, not gross. Because take-home pay is already a smaller number than gross income, and because this percentage is itself more conservative than the bank's front-end maximum, the resulting home price is typically noticeably lower than what a pre-approval letter suggests. This isn't an arbitrary number. It's specifically sized to leave meaningful room in the budget for everything a bank's calculation doesn't ask about. Retirement contributions, an emergency fund, the maintenance costs covered in Part 3, and ordinary discretionary spending, without the household running at the edge of its capacity every single month. Part 3. The hidden costs banks don't fully factor in a mortgage payment is rarely just principal and interest, and several real recurring costs are easy to underestimate when focused only on the headline loan amount. Property taxes and homeowners insurance, together with principal and interest, make up what's commonly called PITI, the full, real monthly payment, not just the loan portion advertised in a rate quote. Private mortgage insurance, PMI, typically required when the down payment is below 20% of the home's price, adds an additional monthly cost specifically to protect the lender, not the homeowner. And it's easy to overlook when comparing advertised mortgage rates that don't include it. HOA fees, where applicable, function as an additional fixed monthly cost on top of the mortgage itself and are sometimes left out of casual affordability estimates entirely. Ongoing maintenance, which doesn't show up in any mortgage calculation at all. A commonly used rule of thumb budgets roughly 1 to 2% of the home's value per year for maintenance and repairs, meaning a $300,000 home might reasonably need $3,000 to $6,000 a year set aside, separate from the mortgage payment, for the inevitable repairs that come with owning rather than renting. None of these show up in a bank's pre-approval letter, which is precisely why that letter can't function as a real affordability number on its own. Part 4. Markets. The exact step-by-step calculation. Step 1. Calculate your true monthly take-home income. Use your actual deposited amount after taxes and deductions, not your gross salary. The same starting point used in this channel's budgeting video. Step 2. Set your target PITI payment at 25 to 28% of that take-home figure. This is your real budget ceiling for the full housing payment, not just the loan portion. Step 3. Subtract realistic estimates for property tax, homeowner's insurance, PMI if your down payment will be under 20%, and any HOA fees from that PITI target to find your actual maximum principal and interest payment, the part that determines your loan size. Step 4. Use that maximum principal and interest figure along with current mortgage interest rates to calculate the maximum loan amount that payment can support. Online mortgage calculators can run this in reverse. Input the maximum monthly payment and interest rate and solve for the loan amount rather than the more common approach of starting from a home price and calculating the payment. Step 5. Add your planned down payment to that maximum loan amount to arrive at your real maximum home price, the number to actually shop within, distinct from whatever larger number the bank's pre-approval letter states. Step 6. Stress test the payment against a single income scenario if your household has 2 incomes. As covered in this channel's 2-income trap video, sizing a mortgage to require both incomes indefinitely removes the safety net a second earner would otherwise provide. Ask specifically whether the PITI payment from Step 2 would still be manageable, even if uncomfortably tight on your larger single income alone. Part 5. 5 mistakes that leave people house poor. Mistake 1. Treating the bank's pre-approval number as the target rather than a ceiling to stay well under. As covered throughout this video, that number is calculated for the bank's risk tolerance, not your financial comfort. Mistake 2. Forgetting the 1 to 2% annual maintenance rule entirely. A payment that looks comfortable on paper can become tight fast once a real repair bill arrives with nothing set aside for it. Mistake 3. Not accounting for PMI when the down payment is under 20%. This is a real, recurring monthly cost that's easy to leave out of an early back-of-envelope estimate. Mistake 4. Sizing the mortgage to combined household income without a single income stress test. As covered in Part 4 and in this channel's 2-income trap video, this is precisely the pattern that removes a household's financial safety net before anything has even gone wrong. Mistake 5. Putting down the maximum possible down payment without considering the opportunity cost. A larger down payment reduces PMI and monthly payments, but it also reduces liquid savings and emergency fund coverage, worth weighing deliberately rather than defaulting to biggest down payment possible, without considering what it leaves you holding in reserve. A mortgage pre-approval answers the question, what's the bank willing to lend? It was never designed to answer what will actually leave me financially comfortable. And treating those as the same number is exactly how people end up with a home they technically qualify for and genuinely struggle to enjoy living in. So here's the one action. Before you start house hunting, run the calculation from Part 4 using your actual take-home pay, not your gross salary or your pre-approval letter, and treat that number, not the bank's number, as your real ceiling. If this helped, do me a favor and hit subscribe. That's genuinely what grows this channel, and you'll catch the next breakdown the moment it's up.